Stop, do not believe that the March delivery crisis is resolved. It is Wednesday, February 25, 2026. The price of silver is hovering at $88.25. Tomorrow is the final session before First Notice Day, Friday, February 27th, when the March COMEX contract officially opens for physical delivery. Open interest has rolled. The alarm has been silenced. The crowd is quiet. They want you to believe the Black Swan landed safely and disappeared into the sky. They are wrong. What happened in these final weeks of February was not resolution. It was relocation. According to exchange data and market intelligence, approximately 350 million ounces of March demand has now migrated forward to May. The registered vault backing those contracts holds approximately 87 million ounces. Ladies and gentlemen, analyst here. The battlefield has shifted. The war has not ended, and May just became the most consequential delivery month in COMEX silver history. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let me lay out the exact architecture of how COMEX arrived at its February 25th position, because the mechanical sequence from October to today reveals precisely why May is now under greater structural strain than March ever was at its worst. Exchange data and market intelligence confirm the 5-year registered inventory collapse that served as the backdrop. Registered silver, the only metal available for physical delivery, fell from 346 million ounces in 2020 to approximately 88 million ounces in February 2026. That is a 75% destruction of the deliverable buffer over 5 years. Of that decline, a 38% segment was compressed into just over 3 months from 167.7 million ounces in October 2025 to 103.5 million ounces by early February 2026. The drainage rate, confirmed at 785,000 ounces per day, meant analysts projected only approximately 85 million ounces would remain at First Notice Day, February 27th. Reports confirm the vault actually hit all-time lows during February 2026, was settling near approximately 87 to 88 million ounces, down 75% from the 2020 baseline. The opposing side of this vault was a March contract carrying open interest ranging from 429 million ounces in early February data to 528 million ounces notional, representing over 100,000 contracts at 5,000 ounces each. Sources confirm the ratio was explicit, over 4 times the deliverable supply concentrated in a single delivery month. Some sources described it as a 416% leverage multiple against deliverable stock, structurally beyond what normal emergency response mechanisms were designed to absorb. This was the Black Swan setup. What prevented it from exploding on February 27th was not new silver. It was the systematic rollover of approximately 350 million ounces of March open interest to May. Reports confirm this rollover was executed through 3 simultaneous mechanisms. First, bullion banks running exchange for physical operations, contacting major long position holders and offering several dollars above spot price to accept a London position rather than stand for COMEX delivery. Second, algorithmic and late-rolling traders electing paper continuity over delivery logistics. Third, the exchange's own administrative machinery facilitating month-forward transitions through depository notification channels. The result on February 25th, March open interest has substantially contracted from its peak. The price of silver consolidates at $88.25, and the mainstream commentary is filing this under avoided disaster. But the open interest migration data tells a different story. The demand was not satisfied. It was relocated. May 2026 now carries the load that March carried throughout January and February. And the vault that must face May has approximately 87 million ounces, a number that is structurally insufficient to service even the most conservative delivery scenarios on the rolled position. The escalating delivery history confirms the trend is not reversing. Reports confirm total COMEX silver deliveries in 2025 reached 474.4 million ounces, more than double 2024's 202.7 million ounces. Every single month of 2025 exceeded the same month of 2024. January 2026 alone recorded 49.4 million ounces delivered, 7.27 times the January 2024 level. February's early days produced a 98% delivery rate from open interest. These numbers do not describe a market stabilizing. They describe a market where the preference for physical metal over paper settlement is accelerating with each passing month. And that acceleration is now aimed squarely at May. The 4 mechanical layers that kept March from breaking in the final days before February 27th are the same 4 layers that must hold again in May, but each one enters May in a weakened state. The first layer is the EFP escape valve. According to market intelligence, bullion banks employed exchange for physical operations as their primary crisis diffusion tool after First Notice Day. They called major long position holders and offered massive cash premiums, often several dollars per ounce above spot price, to abandon COMEX delivery demands and accept a spot position in London instead. This mechanism is not a physical settlement. It is a financial bribe to redirect demand from New York vaults to London's system. Each time it is deployed, it transfers physical pressure from COMEX to LBMA, and LBMA, as market intelligence confirms, is itself a trust-based system operating on a thin physical foundation. The EFP valve does not destroy demand, it reroutes it. The second layer is the cash settlement backstop. Market intelligence confirms that COMEX possesses explicit contractual authority embedded in its rulebooks to cash settle contracts for standing delivery holders if physical metal is unavailable. CME Rule 701, force majeure, grants the exchange authority to cancel physical delivery obligations and force long holders to accept dollars. A clearinghouse default fund contributed by all exchange members provides additional backstop, but sources note its adequacy in extreme modern conditions remains untested. The Silver Rule precedent from the 1980 Hunt Brothers squeeze, when exchanges converted to a sales-only market and banned new buy orders, demonstrates the historical playbook. Reports confirm margin requirements were already at 60% in February 2026, following repeated hikes, a figure that has historically been used as a mechanical lever to force leveraged longs out of positions before delivery. The third layer is the ETF vault extraction mechanism. Intelligence from market analysts identified the operationally most plausible rescue mechanism used in March, quietly sourcing silver from the approximately 91 million ounces sitting in the iShares SLV New York vault to cover COMEX delivery demands. Analysts note the largest silver ETF holds approximately 350 million ounces globally, with the New York portion serving as the most accessible extraction point. This is not purely hypothetical. Sources confirm that in January's vault decline, COMEX registered inventory dropped 18 million ounces in the first week, while total deliveries reached 33.45 million ounces, the balance sourced from allocated inventory or eligible to registered conversions. The SLV vault rating mechanism cannot be deployed indefinitely without triggering redemption demands from SLV's own institutional holders. The fourth layer is the eligible to registered conversion buffer. Reports confirm approximately 403 to 411 million ounces of total COMEX silver exists in an eligible category, meeting delivery standards but lacking the warrants required for immediate delivery settlement. The owners of that eligible silver have made a collective decision. They are not converting to registered at today's prices. Intelligence confirms they are holding for higher. This is the critical structural bottleneck. The metal is physically present inside COMEX-approved vaults, but it is economically withheld. The eligible owners understand the same math that the delivery-demanding longs understand. 75% of the registered pool has been destroyed since 2020. The eligible buffer is the last strategic reserve. Releasing it at $88 when the trajectory points to $150 or higher is irrational. They are waiting. Mexico adds a supply-side shock that the emergency mechanisms cannot address. Reports confirm that Mexico, the world's largest silver-producing nation at approximately 202.5 million ounces in 2025, faced sudden security disruptions in mining regions following cartel leadership changes in late February 2026. When 1/4 of global mine production faces jurisdictional risk, the 7 to 10-year mine development timeline that prevents high prices from generating new near-term supply becomes even more consequential. Sources confirm industrial users now hold only 30 to 45 days of silver buffer, down from the historically normal 120 days. A Mexico supply disruption at current buffer levels translates directly into emergency delivery demand on the COMEX system. The sentiment story of the final 2 weeks of February 2026 is the story of a market correctly reading the short-term de-escalation and incorrectly concluding that the structural condition has resolved. Reports confirm the delivery data escalation through January and early February was unprecedented. January 2026 delivered 49.4 million ounces, 7.27 times the January 2024 baseline. February 2026 recorded a 98% delivery rate in its opening days. Analysts described it as a market that had converted from a paper pricing mechanism to a physical allocation mechanism. These numbers drove maximum fear. Social media amplified default narratives. The forums peaked in alarm. And then as the rollover mechanism quietly absorbed the open interest and the first notice day approached without an explosion, the fear faded. This is the sentiment trap. Market intelligence confirms that institutional capital was not retreating during the $88 consolidation zone. Sprott Physical Silver Trust announced a doubling of its capital deployment capacity to $2 billion, at the moment when retail sentiment was reading the de-escalation as resolution. At the prevailing prices of approximately $110 during that announcement period, $2 billion represented approximately 18 million ounces of buying power, equivalent to 16% of the entire registered COMEX inventory. Reports confirm capital was simultaneously flowing out of SLV and into PSLV and SIVR, the physically backed structures with stronger custody claims. Sophisticated participants were distinguishing between types of silver exposure in real time. They were increasing their physically backed allocation at the exact moment the default fear news cycle was cooling. The corporate procurement intelligence adds the most powerful sentiment layer. Reports confirm that mid-January 2026 saw Tesla assembling a one-off physical silver purchase of 85 million ounces, assembled through mine contracts, vault acquisitions, and private deals, deliberately avoiding public exchanges. Samsung locked in 100% of a restarted mine's output for 2 years through a $7 million prepay arrangement. These are industrial survival decisions. They are not speculative entries. They represent corporate procurement managers who have concluded that the exchange-based supply chain is too fragile to guarantee the silver their manufacturing operations require. When industrial users exit the exchange and lock in supply through direct contracts, the open interest that remains on COMEX represents a more concentrated and less distributed delivery demand, making each first notice day more volatile, not less. Sources confirm 44 Indian trading firms in Rajkot declared insolvency during the January squeeze cycle, caught short as silver surged. This is the collateral damage profile of a market that has already produced real financial casualties. It is not a forward-looking warning sign. It is confirmation that the structural stress already generated economic failures at the institutional level. When institutions fail in the early stages of a squeeze cycle, the later stages produce larger and more concentrated failures. The 5-year deficit history provides the sentiment anchor. Reports confirm annual industrial silver demand now exceeds 650 to 700 million ounces, while global mine supply runs at approximately 820 million ounces per forecast year. The remainder must come from inventory or recycling. Recycled silver provides approximately 180 to 190 million ounces annually, and that share has barely grown in a decade. The 2024 structural deficit alone was 148.9 million ounces, driving a 4-year cumulative shortfall to 678 million ounces, equivalent to 10 months of mining supply in 2024. Every month of $88 silver prices adds another month of structural deficit to that ledger. The May delivery campaign opens from a deeper deficit position than March did. The bear case against the May squeeze must be stated with full force, because it identifies the specific conditions under which the relocation of 350 million ounces from May does not produce the expected delivery crisis. The strongest bear argument is the denominator argument. Market intelligence from professional analysts confirms that COMEX open interest is a flow, not a fixed stockpile. Contracts are created, rolled, closed, and settled continuously. The 98% February delivery rate was calculated against residual open interest after most positions had already rolled, producing an artificially alarming fraction. The actual physical delivery demand in February was 18.72 million ounces, a large number historically, but not catastrophically larger than the vault could service given that registered silver includes warrants that change ownership without metal physically moving. When a warrant transfers, the COMEX registers it as a delivery, but the silver remains in the same vault, in the same bar, in the same position. Paper ownership changed, physical location did not. This argument has genuine merit on a transaction-by-transaction basis, but it does not address the cumulative physical withdrawal reality. Reports confirm total COMEX inventory fell from 346 million ounces in 2020 to approximately 87 million ounces on February 25th, a 259 million ounce physical loss that cannot be explained by warrant transfers. That metal left the vaults, it was physically transported. It is genuinely gone from the COMEX system. The denominator argument explains some of the delivery count. It does not explain the 80% physical inventory reduction. The institutional counter-argument from analysts who don't want chaos is legitimate. A COMEX default would disrupt price discovery, reduce liquidity, and trigger regulatory intervention. Long-term silver investors benefit more from orderly repricing than from systemic crisis. The May squeeze, if it materializes, will most likely take the form of escalating EFP premiums, rising lease rates, and a grinding price advance that forces the eligible buffer owners to convert, rather than a single-session default explosion. That orderly repricing path does not require the dramatic black swan event to produce enormous returns from today's $88 entry. It requires only that the math of 350 million ounces of demand against 87 million ounces of supply eventually forces a price clearing level that is substantially above 88. The Stanford solid-state battery research adds the demand escalation that makes the supply side irrelevant to the medium-term directional case. Reports confirm research published January 16 in Nature Materials demonstrated that a 3-nanometer silver coating makes solid electrolyte surfaces 5 times more resistant to lithium intrusion. the primary engineering barrier to commercial solid-state battery adoption. If solid-state battery manufacturing scales in the second half of 2026 and beyond, silver demand per vehicle increases materially above the approximately 100 grams already required per conventional EV battery. Global EV adoption is on track to triple by 2030. The demand floor is not static, it is accelerating. The U.S. government's acknowledgement of silver's strategic importance, adding it to the critical minerals list and launching Project Vault to stockpile critical minerals per market intelligence, confirms at the sovereign level that the physical scarcity thesis has moved from investment community analysis to official government recognition. When the United States government begins stockpiling a commodity, it is not speculating. It is operationally protecting its industrial base. That institutional action removes supply from the available global pool and adds a permanent buyer to the demand side. The May squeeze will occur in a market where the U.S. government is a strategic accumulator. Industrial end users are running on 30 to 45 days of buffer. Eligible owners are withholding conversion, and the EFP mechanism is progressively more expensive to execute. The battle plan for the May delivery campaign. March's Black Swan has been relocated. The vault sits at approximately 87 million ounces. First notice day for May is approximately 90 days away. Here is your operational map for the bridge period between February 25th and the May 1st notice date. Position 1, the vault tracker floor. Approximately 87 million ounces on February 25th. This is your primary leading indicator. Analysts note the daily drainage rate reached 785,000 ounces at the peak stress period. If May's first notice day arrives with registered inventory below 70 million ounces, the EFP mechanism becomes structurally incapable of absorbing 350 million ounces of demand at any financially tolerable premium. Watch the vault data. If registered falls below 75 million ounces within the next 30 days, the May squeeze activates early. Position 2, $83 to $85. The immediate line in the sand. Reports confirm eligible owners are withholding at current prices. A close below 83 signals that the short-term EFP premium operations are providing temporary price suppression rather than genuine structural resolution. Below 83 is not a collapse. It is an accumulation opportunity, the coiled spring being compressed one final time before the May delivery math reasserts itself. Position 3, $88.25. February 25th's equilibrium zone. The eye of the storm. This is where approximately 350 million ounces of rolled demand sits in price-neutral suspension. The next trigger, whether upward from vault drain data or downward from short-term suppression, will break the equilibrium. Every session that holds 85 to 90 is a session where the May battle lines are being drawn invisibly. Position 4, $92 to $94. The neckline, the level where the rolled May participants face their first genuine decision, roll again to July, or stand for delivery. At 94, the arbitrage between EFP premiums and delivery costs begins to favor standing. At 94, industrial users running on 30 to 45 days of buffer begin calculating that the cost of another deferral, at 30 to 45 days of production exposure, exceed the EFP premium being offered. 94 is not just resistance, it is the reactivation threshold. Position 5, $100 to $110. The convergence zone where vault math meets industrial urgency. If registered silver sits at 70 to 80 million ounces when May delivery begins, and industrial users refuse another EFP deferral, and eligible owners begin converting at prices above 100, the gap closes from both sides simultaneously. 100 to 110 is the first equilibrium in the orderly repricing scenario. 120 to 150 is the Black Swan scenario. Scenario 1. Orderly repricing. Eligible owners accept conversion at $95 to $100. Registered inventory stabilizes between 90 and 110 million ounces before May 1st notice day. EFP premiums of $12 to $18 clear the majority of rolled demand to July. Price grinds from 88 to 94 to 100, over 8 to 12 weeks. The system survives, but every surviving session drains the vault further. Diamond hands accumulating between 85 and 90 capture the full advance without chaos. Scenario 2. Delivery pressure break. Registered vault falls below 75 million ounces by mid-April. Eligible owners hold. EFP premiums exceed $20, but fail to dislodge all 350 million ounces of demand. Mexico's supply disruptions reduce new inflows to the system. Industrial users refuse the fourth sequential EFP deferral. The gap between 350 million ounces of demand and 75 million ounces of vault cannot close through financial instruments. The price bands of 100 to 120, 120 to 150, and 150 to 180 that analysts identified for March now apply to May from a weaker vault position. Your question for the comments. With approximately 350 million ounces of March demand rolled to May, and the COMEX vault at approximately 87 million ounces on February 20. Fifth, do you believe the EFP and cash settlement mechanisms will hold again? Or is May the delivery month that runs out of road? State your level below. This is Analyst here. The Black Swan changed addresses. The vault math has not changed. See you at the May 1st notice day. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.